I have a quick history of real estate, and I'm not really going to go into this too much, but the time that we're in right now is very unique in history. If you look back 2,000 years ago, we have some like traces of what we have today in regards to personal property laws and things like that. And then you get to the 9th and 15th century, you have European feudal systems, which is similar to like Game of Thrones, think that way, where the peasants serve the land and you kind of extract agriculture, production and stuff like that. And then it wasn't really until, recently we got to the point where we have the property laws we have today. And that kind of correlates with Adam Smith and a lot of the economists at the time, a lot of the elites starting to publish work, and the beginning of America. And that's when, the property laws that we see today really started to happen. A really good example of this is William Penn in Pennsylvania. So he was gifted, Pennsylvania to pay a debt that his father had owed, or King Charles owed his father. And anyway, that was like the start of Pennsylvania, and that's how a lot of the colonies started. So this last piece right here, real estate is a major market. So this is, I actually updated this. I believe there's like 34 trillion in equity in the residential real estate market currently. And that's not including mortgage-backed securities or any derivatives that you guys were just speaking about a little bit. So housing has a major impact on our economy. And pretty much anytime you buy real estate, you are using leverage. So interest rates have a major impact on real estate prices. This is a quick slide on the business cycle, short-term and long-term debt cycles. This is from the St. Louis Fed, so they know this is a thing. This is a real thing. So basically, when you have a good balance sheet, like at the beginning of a credit cycle, you have a good balance sheet, you're making money, right? You're credit worthy. You get loans. As you get loans, that debt service becomes more burdensome. You hire more people. Sometimes your productivity goes down, and that's the contraction phase of a debt cycle. And these debt cycles are 7 to 10 years, give or take 3 years or so. And then the long-term debt cycle is the rise and fall of empires, which Ray Dalio talks about in all of his books. You should definitely check out Ray Dalio. I think you've read a lot of Ray Dalio, Jimmy. Yeah. So longer-term debt cycle is basically the rise and fall of currencies and their use as a reserve currency. I'm not drawing any conclusions in this presentation today. I'm just putting out a bunch of stuff.
YouTube video with that exact title.
Yeah, you should look at that.
What's the name of that?
Ray Dalio. Just type in Ray Dalio. Yeah.
There's a great YouTube video with that exact title.
Exactly. Bridgewater Associates. He ran the most successful hedge fund for a long time. Commodity-based currency versus fiat currency. So, ever since 1971, we've been on a fiat currency system when Nixon took us off the gold standard completely. The first step of that was 1934 when we came out of the Great Depression. Since then, we've increased government spending, astronomically. We're currently in a crisis, a debt crisis with our interest payments, as they are exceeding, Medicare and all of our other spending right now. And when a government debts are denominated in its own currency, you can print more money, and that actually does two things. It allows you to keep spending, and it devalues the debt that you have, right? Because it's not backed by any commodity, it's in your currency. So real estate and the socialization of housing. So one of the things I noticed when I was doing this is when you look at every recession, because real estate has such a major impact on the economy and on like a person's security and their desire to want to get up every morning and work, to build their community and things like that. The government has recognized this, and they believe in home ownership, right? Because that's what spurs innovation, things like that. So anyway, throughout my research, I found that anytime there was economic uncertainty or a downturn in the housing market, they typically created new agencies or new acts to try to correct them. I have a timeline here of the FHA and some of the agencies that they've started. This is just, this doesn't touch on anything really. This is just the FHA timeline. But you can see here, coming out of the 1933 Great Depression is when FHA actually started to try to spur some of the housing development. So credit expansion creates major wealth gaps. And so they try to redistribute that wealth to first-time home buyers type of thing. Here's some more on that. These are just some of the acts that we've passed throughout history that affected housing. And this is not all of them. A big one I'm leaving out is 1999 Siegel Act or something like that. So the last 100 years, I'm going to go over really fast in housing. So I have some charts here that kind of correlate with what I'm talking about. So the beginning of the 1900s, we saw massive immigration to Ellis Island. That's when my family came here. You saw big price increases in urbanization, and we saw a major expansion of our economy. I'm going to go right into World War I because this is going to get long, so I'm going to go through this fast. World War I, the USA saw major expansion. We supplied weapons to allies. We made out really well in that war. We weren't involved until the last year, so it was actually a really great thing. But a lot of people were moving to urban centers to be closer to wartime production so that they could earn money. And because so much labor was focused on the war effort, nobody was building housing, right? So the government actually created a housing corporation to build housing, set up housing near arsenals and shipyards to increase that wartime production. And that leads us into the Roaring 20s. So the Roaring 20s was a time of great credit expansion, industrialization, the invention of the automobile. Railroads were really starting to take off at this point. They were super unorganized up until the beginning of the 1900s. So now you see the expansion into the suburbs, as well as urbanization continuing for proximity to jobs. And this leads us to the Great Depression. So 1929 was the start of the Great Depression. 1932, 273,000 people lost their homes. And the next year, 1,000 mortgages a day were being foreclosed. In 1933, 40 to 50% of all mortgages were in default. 30 to 34, housing prices fell about 33%. So coming out of that, in response to try to kick the housing market back to life, they created the FHA and the 1937 Housing Act. So 1934 was our first step off the gold standard. It was illegal to own gold for a period of time. And then that leads us into the post-World War II boom. So basically housing was smoked, and they were doing everything they possibly could to get it to come back to life. And as we went into World War II, there was more government spending, and because there was such a housing situation, the government enacted rent control on basically all of the housing. I think 80%, I have it in here somewhere, but it's very dense. 80% of all housing in 1940 to 1946, the government put under rent control. So this led to slums and all these type of things, because anytime you do rent control, you can't really put money into maintenance like you'd like to. However, sale prices were not controlled, and prices were rising rapidly because of the restrictions. So the 1960s through 1980s. So the 1960s had a strong housing market. So people coming back from World War II, the FHA is around now. They have a pretty good framework for underwriting mortgages, things like that. The VA loan starts to really kick off after World War II. And it really brings us through a great period of housing throughout the United States, all the way up through the 60s. And there was a lot of civil rights movements in the 60s and calls for socialization of housing. But there was continued expansion of the highways, like Eisenhower signed in 1956 the Federal Aid Highway Act, and this led to more suburban housing and building in those suburban areas. And then the 1970s I dub as the stagflation decade. So it was high inflation driven by oil price shocks. Oil shocks as a result of conflict in the Middle East. So OPEC imposed oil embargoes on Israel supporting countries. 1973 was the Yom Kippur War, and anybody that was an ally with Israel, OPEC basically said, we're not selling you oil. And that, oil affects everything in our economy, and it created price shocks and inflation, and it was just a battle throughout the 70s to get inflation down. In 1979, there was another oil shock when there was a revolution in Iran. So housing prices raised due to inflation, and there was a ton of investment into housing as a hedge against inflation. So there was a ton of speculation going on because people were afraid that we were going to devalue our currency, we were going to go into a hyperinflation stage. So there was a ton of speculation. And that leads us to the Paul Volcker area, the 1980s, rate hikes. This is the peak of our rates. The 30-year fixed almost hit 20%. So this cooled the housing market, obviously. But at the same time they were doing this, they were also deregulating the credit industry. And they were passing acts that allowed, there were really good tax incentives when you bought property, right? So at the same time they're raising rates like this, which is really good fiscal policy. When you can raise rates and deregulate something to kind of balance it out, that's good fiscal policy. So even though rates were at 20%, coming out of this decline, we saw a massive uptick because you see the start of ARMs and things like that. You see a real deregulation in the credit industry. And you see let me see here, the Economic Recovery Tax Act of 1981 that Reagan signed, which was an accelerated cost recovery system. It was like accelerated depreciation, except 10 times better from what I read. And housing boomed after they passed that. It went crazy. And people were building commercial everywhere. And then 1986, they took it away. And everything went way down. So through the high interest rate environment, building was still, housing was still doing well. So these are some of the acts I have here that were passed that affected this time. And this led us to the late 80s and early 90s, savings and loan crisis, 1986 to 1995. So 1,043 of the 3,234 saving and loan associations failed. So 32% of all S&Ls failed. The government actually created the Resolution Trust Company to liquidate the assets that the S&Ls couldn't liquidate, obviously. And they didn't finish that until 1995. So the early 90s, we see a massive decline in housing from the buildup of credit of previous generations. Across the decade, real estate prices generally saw a gradual increase. The pace of growth was moderate compared to the boom periods of the 1980s or the early 2000s, but was already sustainable, setting a solid foundation for the more dramatic increases in the years following the 1990s. So this S&L crisis basically deleveraged everything and set the stage for an uprise through the 90s into the 2000s. The 2000s, we had the dot-com bubble where all the tech companies were going crazy, but this didn't necessarily affect real estate that much as it was still recovering from the S&L crisis. But this is what led us to the great financial crisis of '08. So if we go back to the 80s and some of the deregulation in the credit sector, we see the start of ARMs and all those different things. And then through that period, you see deregulation to try to, expand credit. And because of this deregulation and because of the competition of high interest rates, banks got more and more competitive and they really lowered their underwriting practices. So, that was a whole mortgage-backed security, collapse and all that stuff. And these instruments were getting built in the 80s. Like Larry Fink, he runs BlackRock now. He had a major impact on mortgage-backed securities and how to analyze them for risk and stuff like that. So this leads us to now. Coming out of the great financial crisis, rates were left at historical lows. We had a pandemic, etc. We face a lot of the same issues we have faced in the past. So I just talked about macro trends, and migration has a major effect on housing. Market by market is so different, right? We all kind of know that. So this is a chart of some of the migrations that we've seen. So individual markets can perform differently than the real estate market as a whole. However, the effects of credit expansion and contraction are broadly felt. Like I said, most people are using leverage to buy real estate, so it's broadly felt. Migration and population are a major contributing factor to housing production and demand. The areas with the biggest price increases also see the biggest declines. Typically an area is overbuilt or oversupplied during the massive rise in demand. New immigration creates major demand for affordable housing as people moving to this country are usually poor. They end up moving to less desirable markets for affordability reasons, and segregation usually rises out of that. Supply constraints and increased migration cause rises in price. And this chart is the 2022 U-Haul Growth Index. The green is the hot spots people moving into. The red is out. And this is continued. This is a map of the immigration hotspots. Throughout time, different reasons have brought different people to different places. Oftentimes, the circumstances for a move included proximity to work and better quality of life by value compared to what they are earning. So a city's ability to invest in infrastructure and local amenities helps a market tremendously. When a city is like underwater and they can't invest in their infrastructure, that's not good for real estate. This is from the National Bureau of Economic Research. Households migrate in response to local real wages and consumption amenities, that is, characteristics of a locality that affect residents' happiness at a given real wage. So that's kind of what I said, just more technical. Technological advances also have a major impact on migration and demands for housing. For example, the invention of the AC is when you start to see people move south. Before the AC, people really didn't live in super hot climates. So I went through that really fast because I've done this a couple times and I actually took a bunch of slides out. But if anybody wants to download this slide or this presentation, they can go on this QR code and download it to fact check it. I also have like a ton more slides and all my sources.
So Jake, what's the conclusion?
Oh,
We as real estate investors should be taking.
this is what I said. I'm not going to draw conclusions. But
Wait a minute. No, don't draw a conclusion. Don't predict the future. Why is this relevant?
this is relevant because you should understand the history of what you invest in. Yeah. This is relevant because a lot of the patterns that we see in history happen over and over and over again. And by learning history and by knowing what an asset type has done throughout history, throughout different economic reasons or political reasons, you can get a better of an understanding of what might happen today.
And then I do think it's important for us as real estate new investors to understand what a debt crisis is, and more importantly, what a liquidity crisis is. So Medley is always hammering us to pull chips off the table, stay liquid. You guys are bankers, right?
Stay liquid, period.
Does real estate ever fail, or does a borrower's liquidity fail?
Second.
Real estate never fails. Every house that someone lost their ass on in 2008 is now doubled, tripled in value.
I can agree to that.
But what happened? Why did people get foreclosed on?
Liquidity.
They did not have liquidity. There's a great part. The main lesson I took from Ray Dalio's, what was the second book? Not Principles.
Navigating Big Debt Crisis.
Navigating Big Debt Crises is, so you got two economies. And real estate's this magical mix of both economies. You have a hard asset economy that is things people really want. You have paper, because we have a fiat currency, because we need some means of trade for what, now if you go in the history of that, that's its own 45-minute mastermind, the history of currency.
When I got into this, I
we're not
realized
even gonna
this was a
touch
bad
that.
topic to get into.
But then there's a paper economy, which you guys specialize in. And the great thing about real estate is it's this hybrid between a real asset and a paper asset. But in economic crises, the paper economy goes it's a falling knife. And so you need to be liquid for when this paper economy goes to zero or as a falling knife and there's no liquidity in the economy. That's when all of us are most vulnerable. We have real assets, but we don't own all of it because we backed it with paper liabilities. And so what you have to do to feed your paper liability is feed it with more paper. And so if you take all the cash you're taking from your wholesaling businesses and make it illiquid and have rentals, and now you have a huge balance sheet but no liquidity, and on your balance sheet there's no cash, you're in a very precarious situation for a debt cycle. Like, I don't know when the economy will tank, but it will. If you look at the last 300 years of economic history, there's a reason it's called economic cycles. It's not a straight line. But if you look at human GDP since like the beginning of time from 76 to today, it's a hockey stick because real assets are still being created, real values being created, but it's not always matching up with the paper economy. Would you guys agree with that?
Yeah, the expansion of credit over time typically it raises productivity. So if the line is going like this, productivity is going this way still, you know? So even with crashes and increases, we still typically see an increase in productivity. Now when that productivity starts to go down is when you have a bad issue. And on a shorter term debt cycle, your debt service and some of the costs associated with building the big business you just built during the credit expansion phase becomes burdensome. And you have to start spending money now on your debt service and all the people you hired and all these things. And that causes a contraction. And that's happening if you're a person, if you're a business, if you're a bank, pretty much everything. And throughout history, I mean, they've raised rates rapidly, multiple times throughout history. So it would be wise to look at what happened in those other situations.
For 20 minutes, give Ray Dalio, it's a very entertaining video. And the end conclusion of Ray Dalio is the end conclusion of CG and Jason Medley and Eric Brewer. It's increase your productivity, increase your team's productivity. That's the greatest hedge you can have against all economic cycles. But I agree with you. It's something you should definitely understand. I think it's definitely something you can manipulate. Like I sell turnkey houses and I sell them to investors as cash flowing hedges. Like, here's what I know. I know the government will continue to print money, which I know inflation will continue to rise, which I know rents and appreciation prices will continue to go up. It won't be straight line, but in the next 20 years, 10 to 20 years, I think I'm on a good part because the government will continue to print money.
I wouldn't count on the government not printing.
Or raising their productivity.
One of the things that we're doing that's been really common in my book of business, probably the last 8 months, 6 months, I have a lot of my portfolio investors like you guys. You got all these really awesome portfolios of SFR or whatever. I'm doing a ton of cash out refis, even on the ones that they own free and clear, because they're pulling the liquidity and they're holding it. They're hoarding their money right now. So that's just something you guys want to think
Are
about.
they paying 8% to let that cash sit?
Between 6.5 and 7.5.
But they're paying 7.5 to let that cash sit? Interesting.
Because they need the liquidity.
That's a good point.
To get your banking, you guys need liquidity to qualify for your loans, but they're able to bite on the opportunities that come up and they can move quicker. So instead of paying the 12% on a flip loan, they're using their own cash, but they'll move it and then they'll free and clear, they'll refi into long-term debt.
Thank you for that.
That's kind of a little strategy there.
Yeah.
You have to think about cap rates too. I mean, people were buying at like 5 caps. I can have my money sit in a brokerage account and get, like my money's sitting in a brokerage account getting 4.8% rate. It's liquid cash.
Right.
You know, so that 5 cap is not working.
And then the other, to like compound on this conversation, when we're not in a liquidity crunch, you should be making friends with every banker who will shake your hand. And be getting a line of credit for every banker who will shake your hand. Because when you need it, you know, you're not going to give it to you. Because like, I'll never forget, I was in the first, when they shut down the NBA, I was in a CG meeting. And everybody's like, what's this China virus, yada, yada, yada. And then, you know, we were sitting there, the Fed's going to shut down, they're not going to lend anymore. Like, all of us are like, oh my God, we're all done. So everyone got out of the hot seat room and was calling all their bankers and pulling every dollar out of their line of credit. Like when we all thought everything was going to go to the tank. But if you had called a bank the day after they shut down the NBA, say, hey, I'm looking to increase my liquidity. Like it would have been. So when you are meeting with bankers, when you are masterminding with bankers, shake their hand, get access to credit, even if you don't think you need it.
Typically, these are the best opportunities whenever there's a decline. Like during the pandemic is when I really started buying stuff, and I bought a 20-unit building. Like that's where I got
The most successful investors, the ones that are still the most successful, did not hurt at all during that period. They made more money than they ever had.
Because they didn't panic, too.
And they positioned themselves prior to that to be able to do that.
Yep.
2008 was totally different than what happened during this pandemic. 2008 was like the big.
Well, yeah, but not just the pandemic. During the pandemic and inflation
There's
crisis.
always opportunities.
Yeah.
It's the bottom line.
Well, Jake, thank you for condensing that very complex topic. You went through around 300 years of history and a semester's worth of economics in 20 minutes. Thank you.